Welcome to the STARS program, seniors taking active roles in society. And now, here's your host, Anita Finley.
If you want to know about insurance, there's one person that I trust completely, and I think you ought to call him. It's insurance for many things. Mostly, I think it's for the long-term health care. It's for life insurance. Health insurance is a different story when you're a younger person and you have to fight what's going on in the country. But right now, I want to dwell on, of course, long-term health care because I've had it. My husband's had it for a long, long time. And I'm sorry if you didn't get it years ago, but it's still possible to get it now. And I also want to talk about your policy because our great guru, Rob Coulson with US Insurance Auditors, has taught me so much. And one of them now just came through this preliminary injunction, which you just gave me. Why don't you share what's going on, Rob?
Thank you, Anita. It's always good to be here. We've talked about this in previous shows and episodes, and, I think people out there don't maybe grasp or understand or even realize what might be happening to the policies they even own themselves. If you own a newspaper, you get a newspaper these days, New York Times, Wall Street Journal. As a matter of fact, the Sun Sentinel had an article this week of one of the major carriers in Florida. Over the course of the last 18 to, say, 24 months, the life insurance company, specifically with universal life products that are interest rate sensitive, have underestimated what the cost of insurance is on these policies. So what that means is, Anita, when you might have sat down with a planner 20 years ago, 15, 10, 5, they might have written a policy based on illustrations that they believed to be true. What those illustrations showed were internal growth rates of 5.5%, 6%, 7% on those accounts. So years ago, when we were in a much higher interest rate environment, I won't say that was easy for the insurance companies, but they were sure 100% that they could do this. So the imputed rate that they were projecting on that policy 20, 10, 15 years ago was based on you paying that premium every month, year, quarter, however you choose to pay, and having that policy carry that same premium as long as you live, which is called true through maturity. Well, as you know, the last 3, especially 5 years, interest rates are historically low. The bonds, the treasuries, everything's historically low. So the instruments that the insurance companies use to invest the assets that the premium payers, policy owners give them, they're not making 5, 6, 7% anymore. So what's happened is the real rate of return that they're probably getting is 3, 4, 5 at the most. So they overestimated what the growth potential could have been on these policies. And what's happened to the policy owner is, over the course of the last year especially, 18 months specifically, is a lot of these policy owners, hundreds of thousands of them all over the country, are getting letters in the mail saying the premium you've been paying for the last 5, 10, 15 years is no longer good enough. And they say, well, what does that mean? I'm not sure what that means. I remember getting this policy. I remember buying a $1 million policy. If I paid $1,000 a month, that this was going to be good and my estate would have $1 million. My kids, my beneficiaries, for estate tax purposes, whatever that reason for buying the policy was. Now those policies are coming by, those insurance companies are coming back to those policy owners and saying, it was our mistake, but you're going to pay for it. And that hasn't sat very well in the people on our side of the business. The fiduciaries at banks, trust attorneys, insurance agents, financial planners, CPAs, attorneys. These are the ones who have the fiduciary responsibility to the clients, who probably might have advised an attorney, a CPA, might have advised their client to go see that agent, that planner, to buy that policy. And Anita, as you know, as you get older and you retire, what are you on? A fixed income, most people, right? Unless you win the lottery, get a huge inheritance, your property value went up through the roof somehow, you probably live on a fixed income. So what do normal people do in retirement? They build a budget. So they looked at that budget, wherever they bought it, and they specifically probably bought that policy because that's what they could afford. Now they're faced with increases 30, 40, 50%, sometimes 200-300%. So what's happened in this business now is because so many policyholders are being forced to give up their policies because they can no longer afford them. Because specifically using that same scenario, if that $1,000 a month premium all of a sudden goes to $1,500, $1,800, $2,000 a month, that person who's on a budget isn't going to magically find this windfall of an extra $10,000, $15,000 a year. And I'm using this as a small example. Imagine the estates out there that have estate tax policies, 2, 3, 5, 10 millions of dollars. We're talking about huge increases and hundreds of thousands of dollars per year for those people. So what's happened, and what I said was the pushback from our side of the business is the agents, the insurance writers that have promised these policies based on the insurance company's pretense or illustrations that they produced for us were wrong. And now, instead of moving that loss per se onto their books, they're giving it on to the client. So these clients are now being forced to either pay more or give up their policies. And as you can imagine, that hasn't sit very well for people, especially those people that have been paying in these things for many years, just like yourself.
Oh, yeah, absolutely horrible.
So you've experienced this yourself.
I did.
You've seen these increases, and we don't even need to name the insurance companies. You can take it to the bank. It's the top 5 and 10 in the country. And we're talking about billions of dollars of in-face insurance. So what's really happening now is the attorneys for these fiduciaries have now started the legal fight against the insurance companies. Matter of fact, yesterday, the article was out, one of the largest insurers was injuncted by the state to put a hold. A judge put an injunction on it to take a closer look at what's really going on, because it wasn't one person, it wasn't two. We're talking tens of thousands, if not hundreds of thousands of people. So if you're out there listening to this show and you've gotten a letter and somebody said you owe more money than you thought you did, you need to pick up the phone and make an inquiry. You need to maybe reach back to those people that initially sold you those policies. And I'm assuming that they're going to give you the same rebuttal that anyone would, that it's not their fault, the insurance company's fault. And what I want everyone to understand is you're not stuck in a situation that's you cannot handle. There's so many different ways to work around these issues now. Of course, many things are predisposed on your current health and those situations. But more importantly, people are giving up these policies because they can't afford them. So they're taking a full asset away from the estate just because, frankly, the client can no longer afford to keep these premiums. The second factor is there is no determination from the insurance company that these aren't going to just keep escalating. What happens if we continue through a low-rate environment for the next 5, 10 years? It's the exact same thing. There's just going to be more of an implosion on these policies. So what can these people do? One, your policy needs to be evaluated. If you've gotten a letter at all that you had a premium increase, unexpected premium increase, you need to give us a call. We work with all of the carriers, and what we can do is shop rates against each other, see if there's possibly a better scenario for the same premium you were promised 10 or 15 years ago. Because I don't think what the listening public today realizes is $1 million policy at Company A is completely different price than B, C, D, and F. And that is because every insurance company has their own mortality tables. So let me talk about it in layman's terms. If you wanted to buy a $500,000 policy from MetLife, and we shopped that policy with 5, 10, 15, 20 different carriers, we would get 5, 10, 15 different rates back from every single carrier. And those rates can be on literally up to differences of 30 to 50%. So Company A would be charging, per se, keep numbers even and easy, $1,000 a month for that policy. Company B might charge $1,200 a month for that same policy, and Company Z might charge $1,700 a month for that same policy.
But Rob, how can they do that then? If they all worry about the ultimate, what's going to happen, why could they all charge, the difference of that gap?
That's a good question. The reason they use their own tables is because it's their book of business. So if they have 1,000 60-year-olds with $1 million policies, they can look back on their book of business prior and also guesstimate the longevity of that book of business. Now, that same profile might be different at a Met, at a Prudential, at a John Hancock. So they price it on their own mortality tables, not on another company's, because at the end of the day, if their whole book of business lives to maturity, they're going to have to pay out X. So they know that number, and what they do is they amortize that over and try and project the premiums. But coming back full circle again, when you're projecting these out at 6-7%, and the real yield out there is 3.5-4%, 5 on the best day, what are they in there? They're in the hole 2 to 3% per policy. So really, what I'm encouraging people to do, and to keep it simple, if you're getting a letter in the mail that you've had a policy increase in pricing, you need to give us a call. Now, I said there's alternatives to that. One is we can go and look and see if there's a cheaper policy, not cheaper in quality or amount of death benefit, cheaper in price. Because a lot of these illustrations today now are being produced on the lower rate. So now we can really project out at a 3.5%, knowing that's going to be really conservative to that client, to the buyer. Two is, one of the best new products on the market today is it would allow that policy owner. Let me run another example. Let's say that guy has $1 million policy. His premiums were $10,000 a year. Now they're going to be $15,000 a year. Well, he might not be able to afford the $15,000. His estate might still need some life insurance. He doesn't want to turn that back in because he might have little or no cash value, so what can he do? There's a program out there now whereby we could go into the market with a specific situation, and that client could retain a portion of that policy and never pay into it again. So let's run through that again. $1 million policy started at $10,000. He's been paying it for 15 years. Now it's going up to $15,000 a year. He just frankly can't afford that. So instead of calling up the company, asking him to cash out and taking his cash value away, and he has zero left, what these companies will allow people to do today is several things. One is they would allow that customer, the client, to retain a portion of the death benefit, say $500,000. So it's no longer $1 million, but now it's $500,000. They would let that client retain that policy all paid up. So they wouldn't have to put any more money into it. Right. Not even the $10,000 a year he was doing on the $1 million. So now he's got a paid up $500,000 policy. A second option they'll do, maybe that client has immediate cash needs. Maybe they have some medical bills they want to pay. Maybe they have grandkids going to school. They want to stroke a check for their education. What it allows them to do as well, not only can they retain a portion of that death benefit, but through the process, the buying company would actually give them a cash settlement on top of retaining part of that policy. So
they wouldn't get, it would come out of that $500,000.
No.
They're still going to get to 500, but it's the difference of the million to the 500?
Well, what would happen is if they take the $1 million policy, they would reduce the coverage to maybe $400,000 or $500,000. But that person, depending on their age and health and status and all that stuff that we've talked about before, could probably get a cash settlement out of that as well, $20,000, $50,000. So that doesn't sound like, oh, great. Well, I thought once upon a time I had $1 million policy, but we started with you can't afford the $15,000.
Right. So it's a choice of either turning it off, giving it back, saying not paying and losing it.
Exactly.
Or something else. Something else is better than nothing. That's really what you're saying.
I am. And many of the companies today in states actually have passed legislation that require the insurance company to recommend to the customer to do exactly what I just said.
Really?
Yes. Because of the litigation factors of an insurance company, what they really want people to do is give up the insurance.
Of course.
Because
then they've made all that money and they have no more responsibility to pay anything.
Exactly. So because of the other side, we're in a litigious society with attorneys. What's happened and what's forced their hand is actually some structured contracts now provide, if you call up the insurance company and you have a cash value balance, let's say it's $1 million policy, keeping it safe, there's $20,000 cash value in it, right? Mm-hmm. But your premiums are now gone to 15. You can't do that. Your options are to walk away or we'll give you $20,000.
Exactly. They
now have their fiduciary responsibility to tell that customer or client calling in, you might want to look at doing a settlement. It's an option available in the market, and we're obligated to tell you about that.
Okay, now we're going to let you take a breath. I'm gasping. You're doing the talking, and I'm gasping. You've just heard Rob Coulson, and he is his company is US Insurance Auditors, LLC. US Insurance Auditors, LLC, and the phone number to call, I'll give you an 800 number, although he's here locally. It's 800-218-5033. That's 1-800-218-5033. And they have an office in Boca Raton. And besides what he's just talked to you about, he will offer you a free consultation. There's no obligation. If you decide that after he tells you these things, it's not right for you, just say thank you very much, appreciate it. But what he's been saying in his article and his ad, it says if you haven't had your policy evaluated in the past 3 years, there are big changes that you may not be aware of. Many policies have been canceled after years of paying premiums. Many people who can't afford their policies anymore just drop them, and they don't do that. They're saying, don't do that. Please call him, and they can help. So I'm very happy that you're out there. I don't see many people trying to help people like this. You've been really, you've been very supportive. And the thing I like about you mostly is that you have all these unusual ways to help people. It isn't just, cut and dry. You somehow, I don't know where you find all these unusual options and things. Where do you find them?
Well, we use advanced planning techniques. We've been doing them for years. And these new products have given us a huge avenue into being able to do this today. 15 years ago, these products literally did not exist. The one I just discussed, the one that will allow you to retain a portion of your insurance and either walk away with a full paid-up smaller policy,
right?
And or option 2 is to take that little smaller policy, which is still good to the estate because it's now free to you. You're not paying anymore, and get a cash settlement is a brand new structured product. So literally last year at this time, we couldn't even talk about this. So now that the banking system has now stabilized, as you know how horrible it was 4 or 5 years ago, with all of the different stuff going on, now the banks are more on stable footing. So now they're more willing and able to lend against these policies and truthfully help the clients out. Because 5 years ago, it wouldn't have been available. These people would have just had to fold and walk away from their insurance, which is literally the worst thing you can do.
Yeah, I see that. So this is the option. Just don't give up on your insurance.
Absolutely not.
Yeah.
Don't ever surrender your policy to the insurance company without giving us a call. If you have a premium notice in your mail in the last year and a half, 2 years, you need to give us a call because 95% of the time we can give you a solution.
And the thing is that you will do all that managing and worrying for them. You don't expect them to go to the insurance company to do it.
No.
You'll do it because they won't pay any attention to them anyway.
That's correct. Yeah, and we work with them every week on these type of issues, and they're very familiar with them today because, as you know, it's not 1, 2, 3 people. There's thousands of people in this predicament. Yeah. And I know what goes on because I'm in the business world and I understand. People today expect these things like they get an increase on their house insurance. Their car, this is what happens. But it's really not the way it's supposed to happen because that's why when you got your insurance policy, it came with an illustration. Mm-hmm. And that illustration was their promise to you that they were going to deliver that. And unfortunately, it's taking lawyers now to make them realize that they got to do something about this. They cannot keep passing this on, the burden of this, the consequence of this burden to the customer, the clients, that they've been taking money from for the last how many years, and now they've put many, many, many people in a very bad situation.
So there's a class action suit. I just got this on the internet. So it's a preliminary injunction motion filed in South Florida against Transamerica to stop cost of insurance increases. And so there's lawyers behind a class action lawsuit was filed, and will be interesting to see what happens on this. So do you think it can go through?
Oh, I do. I mean, I personally know estate attorneys that are fiduciaries on over 800 policies. And if you need an estate attorney, you have a large estate. We're not talking about million-dollar insurance policies. We're not talking about two. Normally, we're talking about larger policies.
Mm-hmm.
So just because those people have more money doesn't mean they should pay more money.
Right.
And that's really what the insurance company's stance is. They believe that in their little fine print on those policies, and you've gotten policies before. When I deliver them to some people, they laugh, and they say, this is more paperwork than when I bought my first house. And
true.
It certainly is. But it's a fine print that allows them to do this. But at the end of the day, I think that the customer in the long run is gonna win, because the people that have already canceled their policies have lost completely. There's nothing they can do. They've surrendered them. They're probably a lot older, obviously, and maybe not even insurable now. So let's take it forward a few years. If those people couldn't afford those policies were bought for estate planning purposes, wait till their heirs get a hold of the money that they no longer have estate tax insurance for. And when they start stroking checks to the IRS, that's when you're going to see this turn into the client's favor. Because look, if you go to an estate that's worth $10 million, right? Your tax liability on that is at least $1.5–2 million, at least. Okay? Assuming the pass-through.
Okay.
So that's a lot of money. So if that person dies, it's a dad, a mom, whoever, those kids are going to end up saying, who did the planning here? What do you mean we have to stroke a check to the Treasury Department for $2 million? I want to talk to the accountant. I want to talk to the agent. I want to talk to every person involved. That's normally what would happen, right?
Right.
Because somebody did something wrong here. Because the whole purpose of having a trust, an estate attorney, a planner, CPA, all these people that you paid to do this, and now the end result should have been no taxes coming out of their pocket. It's going to come out of the insurance planning.
Yeah, that really, you're very feisty about this. You're very upset, and I can see that. And I'm so glad because you work for your clients, and now your clients, you see them being literally, destroyed if they weren't paying attention and didn't have you. Let me tell you again a phone number. If you like this, you want to hear more about this, why don't you get in touch with Rob Coulson at 800-218-5033. 1-800-218-5033. You can call today for a free evaluation. He'll check over what you do have. He will help you. I can attest to that. So it's great having you around here to do this. Let's maybe in the time that we do have, let's talk about long-term health care insurance. I think it's really important, especially since so many people never got it when they should have. And now it's like out of sight for them. What do you recommend for them to do? Well,
each person is different, as we've always said. So number one is their ability and their financial stability. I mean, there's great policies still out there if you have the wherewithal and you can afford to pay them. Unfortunately, the COI, the cost of insurance increases, have really hit the long-term care industry. As you know, long-term care, as probably anyone listening to this realizes, increases in cost every single year. And it's never going to reverse that course. Right. Because the caretakers need more money, the facilities cost more, and the insurance on the facilities, and everyone down the line. So today, without a long-term care policy, to get admitted to a decent facility, you better have a lot of money. The alternative is to get a long-term care policy. And most people sit there and think, oh, my goodness, there's no way we could ever afford something like that. And the truth of the matter is there's a lot of different ways to get long-term care. You can specifically buy a long-term care policy. There's lots of good carriers out there still doing it. Another way to do it is the hybrid products we've talked about on previous shows. The hybrid products that I know a lot of estate attorneys are talking about now too, which is great for our business, is a cheaper alternative to buying an outright long-term care policy. Because you can provide the estate with not only life insurance, but a long-term care trigger that will let them access that cash while they're alive. So there's a lot of different ways. If anyone out there is looking at our last month's article, what we actually talked about was a cheap conversion, okay? A cheap conversion, to keep it as simple as a day is long, is placing a simple term policy with a guaranteed conversion on it onto somebody in their 60s, early 70s. And what that does is give them what we call peace of mind for at least the next 10, 15, 20 years. How do we do that? A person who's in their mid-60s, 65, 67, just average, could purchase a $500,000 policy today for around $300 a month. Okay? And people are like, oh, well, this type of product, it's term, we'll probably never see anything out of it. Well, what you're trying to do is predict the future. So if you could guarantee yourself for $300 a month that if you got sick, you'd have access to $500,000 cash, would you do it today?
Absolutely.
Most people would, but they don't even realize that they can do this. So real quickly, how you do it. You get sick, you buy this policy when you're 65. At age 74, you have a stroke. You get cancer, you have a heart attack, whatever the things are. You're no longer insurable. The policy I'm talking about has what's called a guarantee insurability rider on it, which means even if you had the heart attack, cancer, and stroke, you can convert that temporary policy into a permanent policy. Once you do that, it lets you access that death benefit for your own uses up to $500,000. So we've created a cash bucket of $500,000 out of a $300 a month policy.
And if you want more information on that, I really do urge you to call Rob Coulson. The phone should be ringing off the wall with all this because it's perfect. It's just absolutely perfect. Phone number to call him is 1-800-218-5033. 1-800-218-5033. We have so much more to say, but Rob, thank you very much. I really appreciate your coming and doing that, and I hope people will take you up on your involvement in this.
Thank you very much. I appreciate it, Anita.